Have you ever thought about investing in the share market but had no idea where to start? Hi everyone, I'm Josh, and in this video I'm going to share with you a simple checklist that some of the best value investors in the world use to find great companies to invest in and buy them on sale. It was Charlie Munger, Warren Buffett's partner, that stated how simple this style of investing is in an interview he did with the BBC in 2012. Charlie had said, "That's a very simple set of ideas, and the reason our ideas haven't spread faster is they're too simple. The professional classes can't justify their existence if that's all they have to say. It's also obvious and so simple, what would they have to do with the rest of the semester?" This coming from a man who's compounded money at huge rates of return and amassed a level of wealth beyond what most could ever comprehend. And this all came from keeping it simple. The simple set of ideas he's speaking of are the steps we're going to cover in this video. So let's get into the 4-step checklist. 1. We have to look at companies we are able to understand. 2. We have to have a business with some intrinsic characteristics that gives it a durable competitive advantage. 3. We would like a company to have a management in place with a lot of integrity and talent. And 4. Regardless of how great this company is, we have to be able to buy it at a price that makes sense and gives a margin of safety. Now I know at first these steps may not sound so simple, so let's break them down and find out how to put a company through these 4 filters. Firstly, what is a company that we are able to understand? Well, that really comes down to you and your understanding of certain companies and certain industries that those companies operate in. And to think about industries and possible companies you could understand, you can start with thinking about what you like to spend your money on, or even what industries you work in yourself. As an example for me, I love sports, and I've previously worked in sporting retail stores. So with this information, I could probably understand how most retail stores operate, and especially sporting retail stores. To further understand specific companies that you're looking at, it's important to read into their annual statements and find out as much as you can about this company. Find out things like how they make money and what products and services do they sell to make that money. Secondly, let's look at how to find if a company may have some intrinsic characteristics that give it a durable competitive advantage. Warren Buffett calls these durable competitive advantages moats, just like the castle that has a body of water around it that protects it from its enemies. The wider a company's moat, the harder it is for its competitors to move in and take away its customers and its market share. So when reading into a company, what would this look like? Moats could be in the form of having a cost advantage or a size advantage. Think of a company that can source its products lower than any of its competitors. This company would have a much better margins on its sales, and it could compete much better with its prices if its competitors tried to lower their prices. Or a company that has a size advantage could be a big name brand that has massive market share in its industry. Because of its quality, brand and size, it is cheaper to operate due to its brand recognition over its competitors. People want that brand and not another. This usually means that the customers would be willing to pay a premium to have it, giving a strong brand company an even better competitive advantage. Another moat could be in the form of switching moat. Think of Apple, for example. If you owned an iPhone, a MacBook, and had an Apple Watch, why would you change brands when it's easy enough just to buy another Apple product and stay within the Apple ecosystem? It becomes both painful and expensive to switch to all new products. One more moat to mention would be a company that has intangible assets that protect it from its competition, such as intellectual property. An example of this would be a patent. If a company has a patent, it's protected against its competitors as they are legally unable to duplicate the particular product or process that they do. This gives your company an intrinsic advantage over its competitors for that product or process. You can generally tell if a company has a strong moat by looking at the growth of their sales, their earnings per share, their equity, and the cash flows, which are all found in the financial statements. Ideally, you would like to see a 10% growth rate year on year for at least the last 5 to 7 years. Let's move on to step 3. We would like a company to have a management team in place with a lot of integrity and talent. This one is pretty self-explanatory and requires you to dig into any information you can find on the CEO in particular, but also the management team as a whole. You can read any news or articles on the management team and get a good idea of what everyone else thinks about them, but be sure to only take into account the facts so you can make your own judgment call on them. Another good method is to read into the company's annual reports, in particular the CEO's review or the letter to shareholders. You can usually get the gist of how they operate and if they have integrity in the messages that they portray. An example, you could dig into the past of a company and see if they had run into any troubles previously and read the corresponding annual reports or any other documents or news and see if the management team were honest about any problems they were having in the company. So this is a good way to test their integrity if they were having troubles. Notice in this step, it says we would like a company to have a management team with integrity and talent, not we must. So ideally, there is a quality management team running your company with a lot of integrity and a lot of talent. And this could definitely be means to put the company into the no basket and move on to looking for another company. But there may be times where a company is so great and has a huge moat that protects it so much that even bad management doesn't affect it. Warren Buffett put it perfectly. He once said, "I try to invest in businesses that are so wonderful that an idiot can run them, because sooner or later, one will." So even though this is an integral step, an important step, there are the occasions where the company is too good to pass up just on this step alone. There are some numbers that we can find that give an idea of how effective the management team is running the company. So we don't want a company that has a lot of debt, especially if we are just starting out ourselves. If a company has a lot of debt, it will generally struggle a lot more than a company with a healthy cash balance and zero debt. So ideally, the company will have zero debt or at most very little, say 1 to 2 years worth of its earnings. You can find a company's debt level on the balance sheet, which is part of the financial statement. It's generally listed as long-term debt. Another good way to measure a management's effectiveness is to look at the company's return on invested capital. You should be able to Google this number to find it, or you can work it out with a simple calculation, which is net income minus dividends divided by equity plus debt. All these numbers can be found in the financial statements. So moving on to step 4, we have to buy it at a price that makes sense and gives it a margin of safety. All this means is that we want to buy this company at a price that is lower than its intrinsic value. So Warren Buffett looks for a 50% discount when he buys at a margin of safety. You may be thinking, how can you buy a company at a 50% discount? Well, it's actually quite simple when you look at the times when the stock market have been really volatile. So think of the global financial crisis in 2008 or the dot-com bubble in the year 2000. Both of these events seen the overall market crash over 50%. In these crashes, quality companies also went down by large amounts. This is where your research really pays off. Some companies' moats would have not been affected, yet their prices may have come down substantially. So realistically, you have a company that's value hasn't changed, yet the market's put it on sale. Warren Buffett has famously said, "Be fearful when others are greedy, and greedy when others are fearful." Well, these are the times when mostly everyone is fearful. But these are the times when great investors are buying great companies for a fraction of their value. There are other times when companies can come on sale also, but we will cover them in more depth in more later videos, along with specific valuation methods to know exactly what price we'd be willing to pay to buy these great companies. So this has been an overview of the 4 basic steps of how to find a great company to invest in for high rates of return with less risk. I'll dive much deeper into each of these steps in the future videos, explaining everything from financial statements to in-depth valuations and much more. So make sure you subscribe and hit the bell icon to catch the latest videos as they're released.